Hello and welcome. In today's video, we will be taking a look at stocks that are incorporated like a REIT or a real estate investment trust. Just like a REIT, they are required to pay out anywhere between 50 to 90% of their income to the investors. However, they do not have any real estate exposure. Hence, they do not collect rent. Instead, they receive a royalty. These are the royalty income trusts, or REITs for short. As I said, the business model is similar to how a REIT operates. However, the only difference is that real estate income trusts own physical property and collect rent on those properties. Royalty income trusts, on the other hand, own intellectual property such as brands and products and services associated with those brands and collect royalty by allowing other businesses to use their intellectual property. So let us take a deep dive into the world of royalty income trusts and understand why this might be a good alternative to REITs, especially in the current market conditions where real estate is at an all time high. For starters, let us take a look at some well known brands of royalty income stocks and compare them with similarly popular REIT stocks. In the first table, we have Pizza Pizza, A&W, and Boston Pizza, which are well known restaurant brands in Canada. Sir Royalty Income Fund is also a restaurant holdings company which holds popular restaurant brands such as Jack Astor's and Scatterbush. In the second table, we have Northwest Health, Riocan, Granite, and Choice Properties REIT. All of them serve different market segments within the REIT industry, which includes healthcare, retail, warehouses, and residential. All of them have high market cap within the REIT sector and have been popular choices when it comes to investing in REIT stocks. The first thing you might notice is that the royalty income stocks are paying on average higher dividend yield compared to the REIT stocks. Not only that, but the price to earnings ratio on average for royalty income stocks is much lower than that of REIT stocks. The payout ratio is quite high for all of them, but that is expected. It boils down to the way royalty income funds and REITs are structured. Depending on their incorporation, both these types of companies are required to pay out anywhere between 50 to 90% of their income to investors. Having said that, you will notice that the royalty income stocks are not exceeding the 100% payout threshold, whereas in the REITs table, Riocan and Granite are well past the 150% payout ratio mark. In case you're wondering why Northwest Properties does not have a payout and price to earnings ratio, it is because in the past 4 quarters they have reported a net loss. Now, it might seem like I'm cherry picking, but we must remember that these are quite popular stocks when it comes to royalty income trusts and real estate investment trusts. Hence, their performance is to some extent representative of the broader market trend. So, in every metric, the royalty income stocks are performing better than the REIT stocks. To better understand the meaning behind these numbers, we need to understand the broader market conditions and the specific risk associated with real estate in Canada, especially in the current economic environment. It would be an understatement to say that real estate in Canada is overvalued. In the past 10 years, housing prices have doubled in major provinces across Canada, as can be seen in this table. The same is also true for commercial real estate. And while the prices for commercial real estate may not be rising as fast as residential real estate, owning them is still getting costlier. On the surface, this might seem like a good thing for REITs, the fact that their real estate properties are growing in value. But we need to remember that REITs do not make money based on the value of their properties. They make money on the rent they charge on those properties. The rent is the bottom line. It is what determines how much dividend they are going to pay out, and it is what determines how valuable a REIT stock is. In fact, if you think about it, higher property prices is a burden for REIT companies. Higher property prices means that if a REIT company wants to expand its portfolio of properties, it is spending more money to do so. In some cases, REIT companies may also take on debt to buy properties. At the same time, the rent that they charge on those properties has a limit. If they charge too much, they will encourage their client to find someone else who is charging a lower rent. In short, with REITs, the cost of their product, in this case the real estate property, keeps getting expensive, but the revenue they are able to generate has an upper limit. Combine that with the recent increase in interest rates, and things only get worse, especially for those REIT companies who had taken on debt when interest rates were lower. It is no wonder that REIT stocks have taken a beating in the past few years. First, the pandemic, and then the unfriendly interest rate environment has resulted in lower revenue and higher expenses. In contrast, the royalty income stocks have pretty much remained unaffected. Yes, during the pandemic, the royalty income stocks did suffer like the rest of the stock market. But since then, almost all of them have recovered to their pre pandemic levels, both in terms of stock price and the dividend paid out. And this is where the business model of royalty income trusts stands out when compared to real estate investment trusts. Unlike REIT companies, royalty income trust companies do not need to own the properties where the business is conducted because they are collecting royalty for allowing the use of their brand name and products and services associated with that brand. It is true that most royalty income trusts do own all or part of the real estate for the businesses that use their brand, but it is not a necessity. More importantly, in theory, there is no limit to how much royalty they can charge for using their brand. As the brand value grows, they can charge higher royalty to new franchisees. In the end, a popular brand means more business, which translates into higher revenue and eventually into higher royalty income. This is particularly true for fast food brands. In case you had not noticed, the royalty income trust companies in the table I had shown earlier in the video were all restaurant brands, mainly dealing in fast food. There are royalty income companies that deal in other sectors as well, such as Freehold Royalties, which manages brands in the natural gas sector. But in my opinion, fast food royalty companies represent a fairly safe investment because, let's face it, fast food is not going away anytime soon. In fact, the convenience of fast, cheap food is only going to result in more brands being formed in the future, and people will continue to flock to these restaurants regardless of how the economy is performing. Hence, in my opinion, these companies have the highest probability of preserving or even increasing the capital value while also paying out consistent income. So, overall, when we are comparing royalty income trusts with REITs, royalty income trusts have a clear advantage over REITs, such as not being dependent on real estate for income and the ability to charge higher royalty based on the amount of business their brand value is generating. Of course, there is the obvious risk of the brand value being tarnished. In such a scenario, both the capital value of the stock and the dividend paid out would take a beating. So, in the end, the decision to invest in either of these types of investments eventually boils down to what type of risk you are comfortable with. The point of this video is not to prove that royalty income trusts are better than REITs. Rather, I am simply pointing out that under the current market environment, which is not very real estate friendly, royalty income trusts might represent a better opportunity for those who are interested in this type of investment. Also, please note that income paid out by both royalty income trusts as well as real estate investment trusts does not count as dividend but is classified as distribution. For tax purposes, in general, it is considered as regular income, and you do not get any favorable tax treatment like you might get in case of eligible dividends. This means if you own these stocks in a regular cash account, you might end up paying substantial taxes at the end of the year, depending on your tax bracket. In fact, it could even increase your tax bracket. Hence, it is best to hold these types of investments in registered accounts like TFSA or RRSP. And with that, we come to the end of today's video. Do let me know in the comments section if you already have any of the stocks mentioned in this video. As always, do your own due diligence before making any investment decision. The information shared in this video is based on my research, conveys my opinions, and does not count as investment advice. Thanks for watching. If you found some value in this video, don't forget to like, share, and subscribe. I will see you guys in the next one.